Hello and welcome to this video on the statement of changes in equity. This is a very important topic. It actually interlinks with many other topics in the A-level accounting course. So this is actually taken from the AQA specification and it kind of relates to the topic 3.7 limited company accounts. So this is a past paper question which was in 2023 under paper 1. And we're going to be looking at how to tackle this question. We also will discuss some of the theory and the key knowledge points that we need in order to tackle a question like this. So let's make a start. In this question, you have information about a company called Rexelwall PLC is preparing the accounts for the year ending 31st of March. So that's your year end, which is 31st of March 2023. The directors provided the following information at the start of the year. So this information here is relating to the start of the year. During the year, quite a lot of different events and activities happen. So you can see a range of activities happening from the 30th of June all the way to the 31st of March. So we have to kind of tackle them. And what I would like to do and a kind of a strategy, you don't want to randomly start tackling random ones. You want to be tackling these in chronological order. So you want to kind of do these in date order where you possibly can. So just a quick scan of the question. You've got a bonus share first thing up. Then you've got a couple of dividends. You've got a final dividend from the last year. You got an interim dividend, and then you also have a proposed dividend that we need to deal with. And then you got some information about revaluation of an asset, in particular property here. Further to this, you have some additional information. The additional information refers to what the nominal price is, how to maintain the reserves, and you got some information about operating profit. So it says the draft profit from operations, and then you have some other information about debentures and tax and depreciation. So let's start with the first kind of activity of the year. The first activity of the year is a bonus share. A bonus issue of 2 new shares for every 5 that have been held was made on the 30th of June 2022. Okay, so first of all, we think about whether that actually relates to our financial year, and it does because it's after the 1st of April 2022 and it's before the 31st of March 2023. So how do we go about tackling this bonus share here? Well, it says that we're going to give 2 new shares for every 5 that have already been held. So the first starting point, we need to know how many shares we actually have in the market because you cannot work out how many new shares you're going to give out unless you know how many shares have already been given out. So we're going to look at the original information that you've been given in the case study. So you got some information about share capital here and share premium here. So you already have a share capital of £1.4 million, which is indicated in the question here. That's fine, that's great. That's how much share capital we have raised in the previous years. But how many shares do we actually sell to raise that much capital? That's what we've got to work out. Because we need to know the quantity of shares, not so much the value of shares. And to do this, we have to find the nominal price because share capital is based on nominal price. So you're going to make a note here. This is always based on nominal price and this is based on premium price. You combine the two and you get the issue price. So always a good tip is just put N plus P equals I. So your nominal plus your premium price equals your issue price. The nominal price may have a different name. Could be called a par value or ordinary value sometimes, but usually it kind of referred to as a nominal value. So let's have a look at if we have any information about the nominal value. So if we look at adjustment number 1, it says that we have the nominal price per share is 25p. That means you are selling every single share for 25p based on the share capital. So now this will allow us to work out how many shares we have issued. So we do 1.4 million divided by 25p. Okay, we divide it by 25p, so this will tell us how, in order to raise 1.4 million at 25p each, how many shares we must have issued. There's a couple of ways you're doing this, so I'm going to do it as I've indicated on here. You got 1.4 million here. We're going to divide this by 25p, which is equivalent to 0.25, and you get 5.6 million. And it's a good idea to write the shares here. Okay, try to keep the pound sign where the value of the shares is, and just put shares where we're talking about the quantity of shares. So we are now going to issue 2 new shares as per the question for every 5 that have been held. Okay, so we're going to divide this by 5 and we're going to times it by 2. We're going to divide it by 5 because that's how much, you always divide it by how much they currently hold, and then you times by how many new shares you are going to issue. So we're going to divide this by 5 and we're going to times this by 2. And then we therefore are going to issue, and again, try to keep the share price, the value of the shares, and the quantity of the shares, in order. So this is an extra 2,240,000 pound shares you are going to give to the shareholders. Now, when you are doing a bonus share, you have to always multiply this by the nominal amount, because the amount of money the value of these shares is going to be multiplied by 25p. So we're going to multiply that value. So we're going to times that by 0.25 and you get 560,000. So by issuing an extra 2,240,000 shares, you the cost of this is going to be £560,000. So listen to the word carefully. I'm not saying this is the money that's going to be raised from the shares, because when we are talking about bonus shares, the company does not actually raise any money. These are free shares to the shareholders. So why would you give free shares to the shareholders? Well, there may be a couple of reasons, but maybe they didn't pay good dividends, maybe just to keep their shareholders happy. Maybe there is some issue in terms of they come in the media for maybe bad reputation or some kind of scandal, and just to keep the shareholders on board and to give them the confidence, they may issue some free shares. So how do we represent this information in this document of the statement of changes in equity? Think of the word, the statement of changes in equity, for how your equity is changed over a period of time. Well, we're going to put bonus shares here. You can put the date as well. Okay, so I'm just going to put bonus shares or bonus issue somewhat along the lines of that. Now we're going to put this answer 560,000 because this is the cost of the shares. This will increase your share capital. So the value of your share capital will 100% go up. Just bear in mind, and it's always easy to get tricked out on this, just have a look at you know, at the headings. So everything in here is in the thousands. Okay. So just be very mindful of that. So that's why I'm only putting 560 and not 560,000. Okay, so we have the share. Now the key thing about bonus, and this is a common mistake a lot of students make, we have to, as a company, I say this company has to pay for these shares. The cost of the shares we've already established is £560,000, but somebody has to pay for it. Well, the shareholders are not paying for it because they're going to get it free. However, the company will therefore have to pay for it from their reserves. And the order that they're paying is in this order here. Okay. So they pay from the share premium first, and then they pay from the revaluation, and then if needed, they pay for the retained earnings. Okay. And how do you know you have to do it in that order? Does it tell you anywhere in the question to do it in that order? Yes, it does. If you look at point number 2 in the additional information, it says the directors maintain the reserves in the most distributable form. So that basically means that the reserves are going to be kept in the most distributable form. So basically, in this order, you will take money out of the share premium first, as much as you can, then the revaluation reserve, and then the retained earnings. So even if you were not given these headings, and it's really important this, because if you were not given these headings here, you always have to write them in that order, okay? Especially if you have bonus shares, because this is the order of your reserves and the order how you actually take money out of your reserves. But what we do, we need to look at this figure here and see if we can actually take the full £560,000 out of the share premium. And luckily enough, in this question, we can. So we take out the full £560,000 out of the share premium. So we don't need to take any out of the revaluation. We don't need to take any out of the retained earnings. In another question, if the share premium value here, let's say just as an example, was only 200,000, then you can only take 200,000 out of the share premium. The rest, which in this case would be the 360, would have to come from your revaluation. And then if you still needed more, you take it out your retained earnings. So it just depends on the question how much you can take out from from each one of these. Let's have a look at the next adjustment. The next adjustment refers to a final dividend. What I am going to do, I'm going to do the working for the dividend on the working page, but I'm going to keep it. I'm not going to put it in the statement of change in equity until the end because we've got 3 different dividends to think about and to kind of deal with. So we want them really to put them on one row. We don't want to put them on separate rows and kind of put them separate. We want to put just one row with all the overall dividend that is paid for that year. So what information do we have about the first dividend on the 1st of August? On the 1st of August, a final dividend of 7.5 pence per share for the previous year was paid on all shares that were issued on the 1st of April, key date, 1st of April 2022. Now, on the 1st of April 2022, you only had this value of shares. Obviously, we already calculated what that translate to in terms of quantity of shares, which we did here. So the quantity of shares was 5.6 million. Okay. So all we're going to do is with that 5.6 million is multiply it by 7.5 pence to work out how much dividend we're going to pay on that first one. So because I need some space, I'm just going to rub this out to show that. So this is the dividend in August 2022 dividend. So you do 5.6 million shares, okay? And that 5.6 million has come from the original share capital, and then you times this by 0.075, so 7.5 pence. So let's just put that in the calculator. Times 0.075. So that means we have to pay a dividend out of 420,000. Okay, so we're going to keep that there. We're not going to put it in the statement of change in equity just yet. We'll do that at the end because we've got a few other dividends to look at. So as a student, what I would be doing, I'll be just marking these off just so I know where I'm up to. Sometimes under exam pressure, you may forget about one particular item. So it's always good to kind of, tick off things that you've dealt with. On the 20th of January 2023, a rights issue, so this is different from a bonus issue, of 1 new share is given for every 4 that have been held. Okay. So we already know from our previous workings that we started off with 5 points. So effectively, this is working 1. This is going to be working 2 for your rights issue. Let's write that down. So this is going to be your rights issue. You have already 5.6 million shares. We established that based on the original share capital of 1.4 million. Now, we also issued some bonus shares. So if you remember on the 30th of June 2022, so if you remember from our working, we did this divided by 5 times 2, okay, to work out how many extra shares we were going to give out. And the answer we got was an extra 2,240,000 shares. So now you have to ask your question based on how many shares there were on the 20th of January 2023, which is after the date of 30th of June 2022. That's why you really should be doing this in date order. 20th of January 2023, you got to work out how many shares you had already issued, the quantity of shares. So we got 5.6 million that we already had issued previously. And then this year we issued an extra 2,240,000. So in total, we have issued 5.6 million shares originally, plus the 2,240,000 shares from your bonus issue. So now in total we have 7,840 shares, 40,000 shares, issued. And again, write the word shares because this is the quantity. It's not in pounds. It's the quantity of shares. How are you going to, what's the distribution? You're going to give 1 new share for every 4 that have been held. So same as what we did last time. We're going to divide this by 4 and times it by 1. Okay. So let's divide this by 4 and times it by 1. You're going to get 1,960,000. So 1,960,000. Again, this is the quantity of the new shares you're going to give out. Now, as we did in the bonus share, this time we're actually going to receive money for these shares. Okay. So if we're going to issue 1,960,000 shares, we're going to receive money in 2 different forms. One is by the share capital, which is times by the nominal amount, and it tells you the nominal amount is 25p. Okay, so that would give you your ordinary share capital, if you like. And then you do the same, £1,960,000. But this time you have to work out what the share premium is. Now, in this question, luckily enough, it just tells you what the share premium is. But sometimes they might give you the issue price, and then you have to think about doing an inverse of this formula N plus P equals I. So if you have the nominal price and the issue price, you'll be able to work out what the premium price is. So you'll always get 2 out of the 3 in this type of question. But I tell you here, it's made at a premium of 20p per share. So we can multiply this by 20p. And this would give you your share premium amount. So let's pop everything in the calculator. So let's times it by 25p first. And it gives you 400, and this is now in pounds, £490,000 you will earn from your ordinary share capital from issuing them shares. And you do the same thing for your share premium, which is 392,000. Now, the way you write this is very different from the way you wrote your bonus shares in that first adjustment. So the way you write this is going to be slightly different. So you would put rights issue here. and you put the ordinary share capital amount, which is 490 here, and then you put the share premium amount at 392 here. So nothing goes here, nothing goes there. Okay. And actually, you can put an X because nothing will ever go here, nothing will ever go there. In terms of when you do a rights issue, it has no impact on your revaluation and no impact on your retained earnings. So now looking at the next adjustment, we have an interim dividend. So a dividend maybe around about halfway through the year. Although this doesn't feel like it's halfway through the year, it's more towards the end of the year. The company wants to pay out 2p per share was paid on all the shares that were issued on the 31st of January. Look at the dates. The dates are very important here. 31st of January 2023 is after the 20th of January when you made this rights issue. So you have to include that in terms of the quantity of shares. So you're going to give 2p for every share that was in issue at that moment in time. So let's recap how many shares we have. Um, so as a working three, this is now your interim dividend. So first point, we started off with 5.6 million shares. Then in the bonus issue, if you remember, we issued 2,240,000 worth of shares. So 2,240,000 pound was issued for the bonus shares, and then we have a rights issue that we made, and we issued, if you remember, an extra 1,960,000 shares. So we issued 1,960,000 shares. So we need to add up all of these shares. Um, and that adds up to 9,800,000 shares. Each of these shares are going to get a 2p dividend. So we multiply this by 2p. Times 0.02, and you get 196,000. So that is how much you're going to pay for. That is how much you will pay for that dividend. Okay. So I'm just going to highlight this in a different color just so we don't lose track of anything. Um, the first dividend we said that we were going to give 420,000 here, and the second dividend we are going to give 196,000 here. Okay. So I think we have a third dividend as well, so we might need to include that, but when we come across that, we'll see if we need to or not. Okay, it's actually on the next line, so that's perfect. So listen to the question very carefully. It says on the 31st of March 2023. So this is still within our financial year because our financial year ends on that date. A dividend of 8p, um, a dividend of 8p per share is proposed by the directors for the year end. And because it's proposed and not paid, we do not include this. Because in the statement of change in equity, we are only looking at the pay dividend, not what's being proposed, not what's gonna happen next year. Because the proposal might get, rejected, so we don't know. Um, so we are not gonna do anything with that. So this is a very much a red herring. We don't do anything with that adjustment at all. So because we got no other dividends, it will make sense at this moment in time to put the dividend in here. Um, and dividends never go in your share capital, have no impact on your share capital, has no impact on your share premium, and never has an impact on your revaluation. So your dividend will always be a negative figure in your retained earnings. So let's add it up. So it's 196,000 plus 420. And that gives you 616,000. So we're going to put we're going to put 616 here. Okay, so the final adjustment we need to look at, I mean, we do have some other kind of additional information we're going to think about in a minute, but let's deal with this adjustment at the top, and then we'll look at the additional information and see what we might need to do with it. Property is revalued to £1,950,000. It had originally cost 1.8 million, and it has been owned for 5 years when revalued. It is company's policy to depreciate at 6% per annum. So what you would effectively need to do here, you will need to work out the difference between the old net book value and the new net book value. So when you are doing a revaluation, so I'm just going to rub this out. Don't think I need this information again, so I'm just going to rub all this out. So I got a bit of space to do some workings. So when you are doing a revaluation, and you may want to write down this as a point of knowledge, you always compare the old net book value against or versus, if you like, the new net book value, okay, to see if the value of the asset property has gone up or down. Well, in this question, we're being told what the new net book value is. It's 1,950,000. Okay? But we don't know what the old net book value is. Okay? We know what the old cost is. The old cost is given to us in the question, and it tells us the old cost is 1.8 million. But that's not good to us because we need to work out what the old net book value is. But they're giving you a fairly straightforward depreciation method of 6% times the cost, and they've owned it for 5 years. So you have to work out in 5 years how much this asset has depreciated by, how much the property has depreciated by in 5 years. So let's work that out. The cost is 1.8 million. And the formula for the straight line method you're going to be using is, remember, there are two possible formulas you could use for the straight line method. So for the straight line method, there are two formulas you can use. Formula number one is your cost multiplied by the percentage. Formula number two is your cost, take away any residual value, divided by the number of years. Now, in this question, we don't have any information about residual values. We do have information about the year. So really, we don't want to be messing around too much with that formula. So we're going to be adopting and using this formula here. So the cost is 1.8 million. We time this by the percentage that you've been given in the question. That's 6% per annum. Okay, so let's pop that in the calculator. So 1.8 million times 6% is going to give us 108,000. Okay. That is every time you have used the straight line method or the reducing balance method, whether it's this formula or whether it's this formula, either of these answers will always give you the depreciation for 1 year only, for the year. Okay. Same with the reducing balance method. Okay. So just a bit of revision actually. If you were to do the reducing balance method, we know that the formula is net book value times percentage. And we know net book value, the breakdown of net book value is your cost, take away your accumulated depreciation. And again, you times that by percentage. Again, whatever answer you get here is going to be the depreciation for 1 year. Okay, this is not the depreciation for the life of the asset. It is not the depreciation for anything else. It literally is the depreciation for that financial year. So because we've had this asset for 5 years, we need to multiply this by 5, right? And we will get the total amount of depreciation of £540,000. Now we can work out the old net book value, because to work out the old net book value, we just do the cost, take away the depreciation. So we do cost, take away the accumulated depreciation, which is the total depreciation, to work out the net book value, equal net book value. So the cost is 1.8 million. The total depreciation for 5 years is 540,000 at the rate of 108,000 per year. So therefore, our net book value, pop it in the calculator, is going to be £1,260,000. So that is now the old net book value calculated. Let's pop that in our original formula here. Our old net book value is 1,260,000. Compare that to the new net book value, and you get a difference of 690,000. So your property has gone up in value by 690,000. And you put here revaluation. Now moving on to some of the additional information we have. Well, we dealt with the first one because we've used that to calculate the share, the bonus share, and the rights issue. And we've done that because we needed that for the bonus share when we actually maintain the reserves. And now this bit here is the bit we need to kind of concentrate on, because in all of your statement of change in equity you have PAT, okay, which is basically your profit after tax. And you should know from your studies, again, I'm just going to rub this out, a bit of like revision going on here. So we know that we're not given the PAT figure in the question. They don't tell you what the profit after tax is in any of the adjustment from 3 to 6. But you should know when you're doing limited company accounts that there are different variations of the profit figure. So you normally start with your operating profit, okay, here, and then you take away your finance cost, okay, better known as interest that you're paying. So you take that away, and then you get profit before tax. Okay, so once you do that, you get your profit before tax, and then you take away your tax, and finally you end up with PAT. So obviously the key bit here is to work out PAT, profit after tax, and this is the information that needs to go into your statement of changes in equity. So let's have a look at what information we have, what information we can calculate perhaps, to see if we can put all these numbers here. Now, do we have any information about operating profit? Well, yes, it says the draft profit from operations for the year ending 31st of March has been calculated as 1,858,000. This figure includes an accrual of legal fees of 292,000, which is no longer required. Okay, so this profit figure has already put an expense in for legal fees, which is no longer required. Well, if you don't need the expense, think about what's going to happen to your operating profit. And so we need to actually, no, we can't just put this 1,858 here, okay? Because that is not the correct operating profit, because we need to adjust it according to the information. So let's adjust the operating profit first. Adjust it here. So we're going to start with 1,858,000, and we are going to add back the 292, sorry. We're going to add back the 292,000, that expense that we no longer need. So if you don't need the expense, it's going to increase your operating profit. So let's pop that in the calculator. So that gives you 2,150,000. So now we can pop this in our operating profit. So we can put 2,150,000. Okay, so let's work our way down this list, see if we can find the next figure. Now, it says no adjustment is required for depreciation. So they've already accounted for depreciation this year. So we don't need to, recalculate the depreciation for this year. Adjustment number 5, it says at the start of the year, uh, Rexerol PLC had a 6% debenture. So when it says 6% debenture, the 6% refers to the interest. Okay. And the interest is always given on an annual amount. So the 6% is an annual interest that they have to pay of £550,000, be payable in a few years' time, in about 7 years' time. So you have to work out the interest for the year. It should be relatively straightforward. You do 550,000 is the loan amount, the amount of the debenture, um, times this by 6%. Okay, you have a full year's interest here, because if you look at the date, it's right at the start of the year. Okay, if they had taken the debenture out halfway through the year, then you only charge half of the interest. If they only had the debenture for the last 4 months of the year, you apportion that to the last 4 months. So you got to be very careful with the dates always. Okay, so 550,000 times 0.06, and you get 33,000. So this is the finance cost for the year. Now we have that information, we can put it here, and we can calculate the profit before tax. And you get 2,117,000. So the last thing, the last piece of the jigsaw is the tax charge, and it tells you here that the tax charge for the year has been estimated to be 708,000. So we just take off the 708,000 here. So we take off that 708,000, and we end up with a final profit of 1,409,000. And this is the bit that goes in your retained earnings. Again, does not affect this. It's best to kind of where you don't need a figure, it's just best to put an X or a zero so you don't get confused. And it's important that you revise where the figure, the layout, the template of it, or where the figures actually go. A lot of it is relatively straightforward, but in the retained earnings sections, you only have dividends and profit after tax. Um, so we're gonna add 1,409,000 here. And then you finish off with your balance carry down at the end, which is the nicest bit to do. So you just simply add up, um, you simply add up this way, 1.4 million, oops, plus 560 plus 490, and you get 2,450,000, and you do the same, 630,000, take away 560, add the 392, and you get 462. Here you just get a 690, and for this one you start off with 1,054,000, take away the 616, and then add the 1409. And if I can just move this up here, you get 1,847,000. So that concludes this question. Like I said, the question is difficult because you've got a lot of adjustments to work at. Key thing to remember in terms of revision notes and revision point, it's imperative that you understand the layout. Okay, sometimes you'll be given the titles, and this here should be in date order. Um, otherwise it makes it very, very difficult if you're not doing it in date order. Key point, bonus shares. These are free shares for the shareholders, and the company is paying for it by taking it out of their share premium. And we mentioned before, you take it out in the order of the reserves that you've written it down in that particular order. So share premium, then revaluation, then retained earnings. Your rights issue has two values. One is your ordinary nominal value here, which is put into your ordinary share capital, and then you have a premium value here, which is put into your share premium. So just remember that formula, really important. N plus P equals I. Your nominal amount plus your premium amount equals your issue amount. Okay. So if you look at this rights issue here, in total, you raised 490,000 plus the 392,000. Okay, so that's the total amount you raised from issuing that rights issue. This dividend obviously includes two separate dividends. We did not include a third one because it's only a proposed dividend and it's not paid. The revaluation is important because we calculated the old net book value against the new net book value. So in order to calculate the old net book value, we use this depreciation of 6% of a straight line method. And then finally, we worked out profit after tax by understanding a limited company account looks like that. You start from operating profit, take away your finance cost, then you get your profit before tax, then take away tax, and then you finish off with profit after tax. And obviously, you just put in the figures, and where you need to calculate figures like finance costs, you calculate them accordingly. Just be very careful with finance costs. If you have taken the loan out mid-year, halfway through the year, towards the end of the year, you apportion it accordingly. Right? And then obviously the tax figure, depending on what information you're given, you may need to calculate that as well. Okay, so hopefully you found that of some use. It's a really good question because it's got a bonus share and it's got a rights issue. It's got a couple of dividends, revaluation, some adjustments to profit after tax. So it kind of really tests a lot of your skills on the statement of change in equity. So the final thing I'm going to say is when this company is redoing their statement of financial position, their new balances would be here. So these are the new balances they would put into the equity section of the statement of financial position. Okay. So if you've been asked in this question to do a statement of financial position and the equity section, you effectively, as a working, you probably do the statement of change in equity and then end up with the final figures here that would go in the bottom section of your statement of financial position as the statement of change, as your equity section. Okay, hopefully you find that useful. Make sure you make notes and kind of, work around the topic as well. Okay, thank you very much.